Good Monday afternoon, class. So today we're going to review chapters 9, 10, and 11. And I posted two spreadsheets under the week 14 materials. So if you do have access to a computer right now and you can pull up the spreadsheet, download it, and open it up, that would probably be helpful to you, I think. But don't worry if you don't have access to that. It's okay. We're still going to, walk through everything and talk through the solutions as well. This is the spreadsheet. It's the one without solutions since I'll be working through and creating them on here in real time. So the spreadsheets is separated into the first page here is different terms and concepts, and that's further separated into chapters 9, 10, and 11. Those are the three chapters on the quiz. Then we have a page for calculating free cash flows, and then we have a page for doing this is chapter 12 material where we did sensitivity, scenario, and break-even analysis. And you'll see in here, I made this, I did most of the work on this spreadsheet already, so we don't have to fully create the spreadsheet. Instead, we just have to know how to use the spreadsheet to do the sensitivity and scenario analysis. And then the last tab here has some questions from chapter 11 that we covered, and just a few questions there. And that should really take up most of the class. All right, let's start off with some of the material from chapter 9. So chapter 9 basically looked at figuring out which cash flows, which costs, which revenues, which different types of items have to go into calculating cash flows for these NPV analysis that we do. And it started off with the basic equation being right here, what I'm highlighting on the screen, is that free cash flows are equal to EBIT, earnings before interest and tax, minus taxes, plus depreciation, minus the increase in working capital, and minus CapEx. So that's the basic equation that we're working off of. I see a question that in the chat that the spreadsheet is different. Check to make sure that you're on the check the bottom tab down here at the spreadsheet and click on the tab all the way on the left. I'm guessing maybe you're on a different tab. And so the key premise for deciding which cash flows to include is whether or not the cash flows are incremental and caused by this project that we're analyzing. And so that's what we want. We want incremental cash flows. And incremental cash flows include cash flows caused by this project. And they also include cash flows that might be side effects of this project. So like if you're coming out with a new product line and you're already selling existing product lines, those existing product line sales might be affected by brand new product lines. So those are side effects, and we would include side effects. Salvage values, where you have equipment left over at the end of your project and you want to sell it off, that's something to include. Shutdown costs at the very end of a project. If you have to pay costs or expenses to shut down a business, that would also be something that we would include. But examples of other things that we might not include would be like sunk costs. And so sunk costs are basically costs that have already been paid, right? And the key thing here is that it doesn't matter if you do the project or don't do the project, the costs have already been paid. So whether or not you do the project has no bearing on these sunk costs. It makes me remember there's a couple like sayings, right, related to this. One is in for a penny, in for a pound. I don't know if you've heard that term before, but basically it means once you've started investing in something, even if it's just a few pennies, that when something bad happens, people have a hard time saying no to doing even more investment, because then you're kind of like admitting that you failed if you stop investing. And this kind of goes back to some of those behavioral biases that we talked about in investing. And so sometimes people, they don't want to recognize that they made an error. So it's like if you bought a stock and the stock price went down. Now I can find lots of studies that say the best thing to do is to go ahead and sell that stock and get out of it. But a lot of people don't do that is because, the thinking, I'm sure the thinking is that, hey, you know what? It's down, but it's going to be back up, right? But if you look at how people behave, the science behind that, it's the thought logic really is that if people were to sell off a losing investment, it's kind of like admitting defeat. You admit then that you really made an error, and as long as you don't sell it, you never have to admit you made that error. So this is in terms of in for a penny, in for a pound, meaning that psychologically, a lot of investors, when they look at a project, if they've already invested a little bit of money, it's really hard for them to say no to investing even more money. But from from a pure standpoint of how you have to be kind of a hard-nosed business person to analyze this, you really need to forget about those pennies that you invested because they're basically sunk costs. The other thing we talked about not including are financing costs. Okay. There were a few examples where they were included, but we're not going to focus on those. As we saw later on, financing costs are going to be built into our discount rates. And then we come to the question of overheads. Overheads were something that you calculated in like managerial finance, where you had a cost or an expense that could not be directly applied to a single product. And so the way to kind of judge the profitability of like a product line would then be they take overheads and they kind of spread it across all the products, kind of like, spreading peanut butter on bread. And so usually they'll do it as like a percent of sales or a percent of some product costing or something like that. And so the reason I say here that it depends whether or not you should include overheads is because I would say for most companies, the default is to include it. But if you ever find yourself in a situation where maybe it's a brand new business and you're doing an investment analysis, that you can make an argument that certain overheads may not be, shouldn't be applied to that brand new investment because maybe those new projects don't use that overhead. But, applying overheads is kind of like the first default option that most companies do. So it says it depends because it really is kind of a negotiation, and it's usually only a negotiation if the NPV is marginal, if it's close to zero. That's when people start arguing whether or not they should or should not include overhead costs. Then we move to Chapter 10. And in Chapter 10, the focus was not on calculating cash flows and NPVs. The focus was on how to analyze the risk in projects when all we have up to now is like a single NPV, right? Because that's kind of one-dimensional, having a single NPV. Because just imagine we could have two projects, right? And one project could have the exact same NPV as another project. But what if the one project was a lot riskier? Like, sales could be $50 the first year, $50,000, or they could be $150,000. I'm not quite sure, somewhere in between. And maybe on the other project, you're like, I'm really sure sales are going to be $100,000 plus or minus just a couple thousand. It's pretty locked in. So those two projects, they might have the same NPV, but when you do some deeper dive into the risk of those projects, you might see differences that might kind of sway you to choosing one project over the other. And this analysis that we did in chapter 10 is the way to do some of that analysis. And a good way to think about this is kind of like what if analysis. What if sales don't go as the way we plan? What if there's some situation or scenario that happens and things start to go bad? What if, sales don't do as well as we thought? At what point is it break even where the project becomes viable? So we have a couple tabs on this spreadsheet that we're going to look at later with examples on how to do this analysis. All right, chapter 11, sorry. So chapter 11 basically starts looking at returns, and it shows different ways to calculate returns and different ways to look at returns. And then also looks at risk and how we measure risk. Those are the key things. Because chapter 11 is really kind of it's almost a lead in to chapter 12. It's introducing us to risk and returns. So the first thing we did is we looked at historical returns and standard deviation of stocks in the stock market, bonds, cash like treasury bills, and also inflation. And we saw how over time those different investments changed in value at different rates, right? And we saw how stocks, even though they had more standard deviation, so they went up and down more, in general, they grew considerably over time. So they had a lot of variation, but there was an upward bias in the returns year over year over year. Conversely, if you look at bonds, they kind of moved a little bit less and they didn't go up as much. And then you have cash, and that didn't really move at all. It was really steady, but the problem was it just never grew. And when you took into account inflation, cash is really just a store. It's a place to store wealth, but it's not a place to grow wealth. And so then we introduced the holding period return equation. Well, I shouldn't say introduced. We did this before. But then we took that holding period return equation and we saw how you can break it down into the returns from dividends. And that component of the return is called the dividend yield. And then we also looked at the return we get from the change in the stock price, and that's just called capital appreciation. We define the risk premium as the return above the risk-free rate. So like if you were to say, the expected market return, one way to look at, and this is kind of forecasting a future return, is to say that return is composed of a risk-free baseline return and then an extra return above that based on how risky your asset is. And for the market, that would be the market risk premium. So we start off with the risk-free rate, and then we add to that the market risk premium. This risk-free rate, in the US, we use treasury bills, like an average of all the outstanding treasury bills. And if you recall, treasury bills are basically treasury US government debt with a time period of less than a year, a duration of less than a year. And for our purposes in finance, we consider that the risk-free rate. So it's risk-free because the government has not defaulted yet. I say yet, knock on wood, right? And it's also risk-free from the standpoint that, with long-term bonds, there's risk when interest rate changes, right? Because you have your money locked up at an interest rate for a long period of time. And if interest rates go up, you kind of miss out on that higher interest rate, right? But with T-bills, there's such a short maturity, they don't last very long, that you can just like get your money back when the T bill ends, and then invest it in the new T bill, which is at a higher interest rate. So you don't have that risk either. So Treasury bills are risk free security that we use. And when we're talking about the expected market return, like we did in this equation up here, right? Because we want to understand how we could estimate what the market return might be on average in the future. And the way we do that is we combine the Treasury bill risk-free rate with the average historical market risk premium. And that gives us a way to estimate what the market return will be. This market risk premium, if we want to do from history an average, what we do is we use a market index to represent that. And the market index is typically the S&P 500. S&P stands for Standard & Poor's. So we can calculate these market risk premiums for every single country that has a traded market and that we have data for. And it turns out, the countries are all over the place. Just because, one country, Greece, has a risk premium over the last 15 years of X% doesn't mean that, Italy's going to have the same risk premium. Or just because, Thailand has one risk premium, would Indonesia have another risk premium? There's usually variation and differences in the risk premium, because this risk premium, remember, we usually use the average historical market return, and markets have all different unique reasons for having differences in those returns between countries. So the bottom line is that these market risk premiums are different around the world for different countries. Then we looked at how we calculate risk for a stock or a different investable asset. And we do that by calculating variance. And that was the equation right there that we used to calculate variance. But we also, I think I showed you how to do it in Excel. And in Excel, we have something called the var.p. And the var.p, we're going to practice that in a little while, is the Excel formula to calculate variance that we're going to use. And then we also have standard deviation. And standard deviation is just the square root of variance. For Excel formula purposes, we can calculate that using this formula in Excel. And again, we're gonna use that in a little while here. So these two both are ways to assess risk in an investable asset. Usually standard deviation is the one that we use, just because it's it's represented in percentage, and so it gives you kind of like the range, how much stock returns range from a median. Usually it's plus or minus two standard deviations is the range where most of your data falls. And so that way it gives you an idea of how to visualize how much risk, how much up and down is in this security. Variance is like, in number terms, it's like a percentage squared. So people don't really, there's not a good way to really apply it in a visual sense so people can see how much variation there is. So we calculate variance, but then typically when we communicate the risk, we usually use standard deviation. So that's how we measure risk, using variance and standard deviation. Then we looked at the relationship between risk and returns. And the key here is that when you have really, really high risk, investors demand a really, really high returns. Also, when there's really low risk, then investors require relatively low returns. So the risk and reward or risk and return relationship is positive and it's very strong and it's all throughout finance. And we saw that, right? When we looked at stocks with really high returns, well, guess what? They had high risk. That's why they had high returns. We looked at, bonds. We looked at small stocks. We looked at cash. And we saw this general relationship. It held all the way through. When you had really high returns, there was a higher standard deviation also. And then we looked at portfolio returns. And so we define a portfolio as an investment with that's split up into different assets. And the way to calculate the portfolio return for a portfolio with just two assets is what you see right there on the screen right now. But really, it's really easy to do for two assets, three assets, four assets. It's just using the weighted average equation. And so the key then for this is you have to figure out what's the percentage of your portfolio that's invested in asset one, in asset two, and asset three. So we'll have an example on that problem that's a little different than the way your homework was. So hopefully that'll keep things interesting. So the reason we talked about portfolio return there, is because then we introduced the concept of total risk. And we said that total risk can be broken up into two parts. It can be broken up into unique risk and market risk. Unique risk is the risk of something happening that only affects one stock. Market risk is the risk of something happening that affects the entire market. And so then we looked at how total risk, right? When you start adding more and more stocks to your portfolio, so like if you only have one stock in your portfolio and risk is up here, but then when you add 2, 3, 4, 5 stocks, 6 stocks, risk starts lowering. It gets lower, lower, lower until you get to about 15 stocks, 20 stocks, as long as they're different in different industries. Your risk kind of flatlines, right? And then we saw in that one slide how the part of the slide that kind of drops away to nothing, that's the top part of the risk, and that's called unique risk. And then we split the bottom away, right? And that never went away. That bottom part of that curve, that kind of flatlined, we call that market risk. And the reason is that when you diversify your portfolio by adding more and more stocks, what you're doing is you're removing unique risk, right? Because if you have 100 stocks in your portfolio, what's the risk that if one CEO in one company that you own says something bad or does something bad, what risk does that put on your entire portfolio? Well, if it's only one stock out of 100 stocks and it's a really small part of your investment, the risk is almost nothing. And chances are that if one company did something bad, another company, one of your other stocks may have done something good. So those unique risks kind of can cancel each other out as well. So unique risk can be eliminated by diversification. That was the key. So as we add more and more stocks, the unique risk part goes away, but the market risk always stays there. So diversification does not get rid of market risk, but it does get rid of unique risk. That was the end of that chapter 11. Any questions on any of those terms or concepts from chapters 9, 10, 11 before we get into some math problems? All right, I'm going to go to the second tab on this spreadsheet. if you've got it. If not, that's okay. And so here's the question. I want you to calculate free cash flow for the year 2021 in this example. Okay? I will step you through the spreadsheet right now, show you what everything means, and then I'll give you like 5 or 10 minutes to go ahead and work on the problem yourself. If you have the spreadsheet, go ahead and use that and work through the problem. If you do not have the spreadsheet, then you can just I'll leave the spreadsheet up here and you just kind of look at it and go through your head what steps you would go to solve this problem. All right, so first off, here's the equation for free cash flows that we need to use. Okay, and then here are the assumptions that we're going to use. Okay, so first off, we've got sales for 2020, and that's right here. And then we're given, actually, that's sales for 20 and 2021. So both of those sales are already given. Sorry about that. So sales are given for 20 and 21. And then we've got EBIT as a percent of sales. We have tax as a percent of EBIT, assuming there's no interest implications on tax, et cetera, et cetera. We've got working capital as a percent of sales. Then we have depreciation for 2020 and 21 and capital expenditure for 20 and 21. So what I want you to do is go ahead and calculate free cash flows for the year 2021. Okay, so I'm going to go ahead and it's 4:03. I'll give us till about 4:10. Okay, so go ahead and take a few minutes to work on that, please. All right, let's take a look at this then. So we want to calculate this for 2021, right? So I'm going to go ahead and write down all the pieces of information that we need, starting with EBIT. Then we need taxes, then depreciation, then the increase in working capital, and then capital expenditures. Now increase in working capital. So as I look down here, we've got all the information we need for all that, right? But increase in working capital is different than just working capital as a percent of sales. So to get the increase in working capital, we actually have to first calculate working capital by itself, right? All right, so I think that's everything. One more thing about working capital. Now, because it says we need 2021, and we need the increase in working capital in 2021, to calculate the increase in working capital in 2021, we need to know the working capital in both 20 and 21, right? And get that increase. And that's the whole reason we're forecasting 2020 on this spreadsheet here, is because we need 2020 working capital to get the increase in working capital for 2021. Even though we're only asked for the free cash flows for 2021. So then I'm going to put free cash flows down here. Let's see, let's put a little thing here. Okay, so, all right, let's calculate EBIT. So EBIT equals 10%, that number right there, multiplied by sales for that year, right? And the same thing in 2021. 2021 EBIT is going to be this 10% multiplied by sales for 2021. And then taxes for 2020 are going to be this percent right here multiplied by the EBIT for that year. And then taxes for 2021 are just going to be this tax rate here multiplied by EBIT for 2021. And it looks like depreciation, we're just given a number. We don't have to do any calculations. So we got that. And then for 2021, it equals this depreciation right here. So that's not too bad. And then working capital, now that is given to us as a percent of sales. So we're going to have to take that percent of sales and multiply it by the sales number for that year. That gives us total working capital. 2021, we have to do the same thing. 20% multiplied by total sales for that year. And then we'll have working capital for 2021. So now we have to calculate the increase in working capital. The increase is the current year, which is in cell C20, minus the previous year, right? And so we hit return on that. And so that is the increase in working capital for 2021. I'm not going to worry about the rest of the stuff for 2020 because that's pretty much all we need then from 2020. Capital expenditure in 2021 is this right here. And now we can go ahead and calculate free cash flows. So the first thing is it's EBIT, right? And then we subtract taxes right there. And then we add back depreciation right here in the equation. And that's right here. Then we subtract the increase in working capital, WC, working capital. And that's right here. And then finally, we subtract capital expenditures right here in the equation. That's down here. So that should give us our answer right there. 241.635. Looks good. Any questions about that? So that's an example of how to calculate free cash flows when you have like an Excel model. I see Yama said Tesla got added to the S&P. Yeah, if any stock gets added to the S&P, the price goes up. And the reason the price goes up is because of all those mutual funds and exchange traded funds, those index funds, those S&P 500 index funds. All those funds, which are the biggest single type of security in the market in terms of stocks, the S&P 500 index mutual funds and exchange traded funds, they're the most popular investment there is. They all have to start buying Tesla now. And so that's why the stock goes up, because all those huge funds are kind of forced to start buying more Tesla now. But if Tesla got added, that must mean somebody probably got dropped too. So it might be interesting to look at the stock that was, dropped because of Tesla being added. They maybe they didn't do it simultaneously, but if something got dropped, you may see it in the Standard and Poor's news release. Then I'm guessing that stock went down quite a bit. All right, let's go ahead and take a look at sensitivity analysis here. Now, what I did here was I built out the spreadsheet for us, so we don't have to do any real spreadsheet work here. All we're going to do is use the existing spreadsheet. We're going to use it to do sensitivity analysis, scenario analysis, and break-even analysis. But let me give you kind of a tour of the spreadsheet because you kind of need to understand how it works so you can use it. So first off, this is the part for sensitivity analysis. And what I'm doing here is I listed sales growth from 2021 to 2022 as the thing that we want to do sensitivity analysis on. I've listed the worst or pessimistic case of sales growth for that year at 0. I listed the expected at 10% and the best case at 15. So then the whole point of sensitivity analysis now is we're going to go ahead and fill in this yellow area. And that yellow area is going to show the NPV for each 3 of those numbers, worst, expected, and best. Okay. And then after that, we'll go ahead and do the other 2. So here are the assumptions that I put into the spreadsheet. We've got sales growth, we have EBIT, tax. I've made depreciation and working capital equal to 0 just to make it easier to build the spreadsheet. And then here's capital expenditure in 2020. And then all this is already built into the spreadsheet. And the numbers down here represent the expecteds. Okay. In fact, if you go up here and you see the expected 10% sales growth, right? You see that number right here. So that's already built into the spreadsheet. So the first NPV for expected, we kind of already have. It's already built in. That's 137 right there. So I'm going to go ahead and put in 137 as our expected NPV for this project. So the goal now is let's find out what the NPV is in the worst case scenario at 0%, put that NPV in the table, and then recalculate using the best case scenario of 15% sales growth, and then put that one in the table too. And then we'll be done the sensitivity analysis. Okay, so let's do 0%. I'm just going to go ahead and change this one right down here. We'll make that a 0%. And you see it kind of flowed through. We've got a new NPV right here, 107. Let's put that down. Okay. Now we want to go through and look at the best case scenario and see what happens to the NPV. In that case, it's 15% growth. And then we pick up the NPV down here, and we see it's 152. So I'm going to put that in our table. So that is basically sensitivity analysis. And now what we do is we look at this table and you say, well, is there any real risk here? Or are there any real opportunities to take into account? And I think the story on this table is that, there's not a lot of big news here, which is good. The NPV doesn't go negative. So if sales are kind of worse than we thought, we're still going to be okay. So this turned out okay. The next thing we could do is a scenario analysis. And in that case, we're kind of looking at multiple things changing at the same time. It could be, what if a competitor opens up a store next to us? What happens? It could change multiple variables and assumptions, right? What happens if there's some global pandemic? What happens if something changes in the government? So there could be all kinds of things, whatever, whatever your business situation might have to consider. In this case, we have sales growth changing to 5% and EBIT as a percent of sales changing to 7. All right, currently sales is at 10% and EBIT's at 10 as well. So I'm going to go ahead and change these two numbers here to do the scenario analysis. And look, that gives us a negative NPV. I'm going to record that up here. And then I'm going to go ahead, change our assumptions back to where they were originally. Okay, so what that means is when we change those two assumptions, we got a negative NPV. So how do we use this? Well, this is definitely something we have to pay attention to for this project, because if this scenario happens, it makes our investment unprofitable. So then you'd sit around and talk about, okay, can we do any type of contingency planning? Can we change the project in terms of what we planned to make this scenario better for us? The last one is break-even analysis. And in that case, we basically change the sales number. So I'm going to go ahead and because we have a base year sales of in 2021 of 5490, and then the assumption is that the sales just grows off of that. So I'm just going to change our base year sales. 2022 just kind of flows off of 2021. So let's go ahead and do that. So I'm going to change this number right here until I get an NPV of 0. That's going to be my break-even NPV number. So let's go ahead. I'm going to go ahead and try it here. 3,000. No, that's too negative. 4,000. Oh, that's close. 4,300. Oh, that's very close. 4,330. Oh, that's it. So that would be our break-even sales number, 4,330. So with that, you could ask your sales and marketing team, because those would be the people that typically are responsible for coming up with sales forecasts. And you'd ask them, how confident are you in that sales forecast, and how confident that you can meet our break-even level of investment with 4,330 sales. And so depending on that answer, and it's not a scientific response, depending on how comfortable and confident the sales and marketing team is, kind of determines whether or not you should be worried about that.
Professor, I have a quick question.
Yeah.
So I'm guessing we're supposed to have this table at least like set up before we take the exam, because say you give a question like this, I don't want to type in all these factors in there while taking the exam and taking off time,
Yeah, if I have a question like this, I would supply the spreadsheet for you already filled out.
Okay, thank you.
Yeah, because there wouldn't be enough time to have to build a lot of spreadsheets. Maybe one little spreadsheet, maybe, right?
Yeah, it's all good, man. Appreciate it, though.
Yeah, but doing this would be, if you had to build this whole spreadsheet all down here, plus do all this up here, that would be like, that'd probably be like three separate problems. Yeah. And I would give you a filled out spreadsheet so you wouldn't have to worry about that.
Okay, and then just like someone commented below, he said Ghost Fleet gave me 4332. So I had a same problem like that as well. I think one of the homework problems, I used the Ghost Fleet and I got a different answer than what you inputted. So I was just wondering, Timothy in this case is wrong, or
No,
is
he's probably right.
okay?
I didn't 4330 because Excel is probably rounding, right? So he has a more exact answer, I'm sure, if you use GoalSeek. I'm not requiring you to use GoalSeek. For my I know like you probably use GoalSeek. In my investments class, we use GoalSeek. In your operations management class, I'm sure you use GoalSeek, but for this class, I'm not requiring it. As far as I'm concerned, if you can guess a number and get there within 20 seconds, that's fine. And I didn't think it was the most important thing to learn or to practice another tool in Excel for our purposes here.
All right, appreciate it.
Any other questions on this sensitivity scenario break even analysis?
Yeah, can I ask a question?
You sure can.
On that break-even analysis part, when you were entering that number to try and get something to let you know you were at the break-even point, what exactly were you looking at to match to know that it was the break-even?
Well, what I was looking for NPV to be equal to 0, right down there. That's what I was looking for. And what I do is I do that by changing our sales number here the first year.
Okay.
So if I put in 4332, what Timothy got with GoalSeek, that should give me NPV of 0 right here. So just watch that. See, now I'm guessing if we increase the number of significant digits, see, it's not perfectly 0. And I think, what did I do? I did 4330, right? See, it's still it rounds to 0, but it's not quite as precise as GoalSeek. So it's just a matter of rounding. But that's the idea. You change your sales to get an NPV of 0, and then record that as your break-even sales.
Thank you.
Okay, so a little less involved questions here. These are from Chapter 11. If the current Treasury bill rate, sorry about that spelling error on Treasury. If the current Treasury bill rate is 0.1% and the historical average market risk premium is 7.9%, what should the expected market return be?
Will it be 8%?
Yeah, 8% it is. Yeah. So we had a slide where we said the expected market return is equal to the risk-free rate plus the historical average market risk premium. Because what we did is we looked at historical returns and the holding period return equation and history of returns. But what do you do when you want to look forward into the future? And so this kind of starts going toward chapters 12 and onward, where we start making assumptions about the future and what the cost of capital or opportunity cost of capital should be. And this is kind of where it comes from. It's this expected return that's made up of the risk-free rate plus a risk premium. And the amount of risk premium depends on what the asset or investment you're looking at is. And so for the market return, the risk premium is the market risk premium. But we can have different risk premiums. Every asset class has its own risk premium, depending on how risky they are. And so yeah, for this one, it's going to be 0.1% plus 7.9%. And that's just equal to 8.0%. Okay, take a look at this problem now. What is the portfolio return of a two-stock portfolio with $50 invested in stock A and $30 invested in stock B if stock A has a 10% return and stock B has a 20% return? Bear with me for a second. I'm just going to come over here and I'm going to copy this. This was that equation that we talked about a few slides ago. So go ahead and work on this problem. Let me point out one thing. You notice how the equation says fraction of portfolio invested in one? And I think it was on a homework problem or in the slides, I told you what percentage of the portfolio was invested in stock A and what percentage was invested in stock B or 1 and 2, whatever. But here, I'm not giving you the percentage. The percentage you have to calculate yourself. What I gave you is the dollars invested in each of the two stocks. So that's just my hint for this problem. Please go ahead and take a couple minutes and work on this one. What'd you guys get for the fraction of the portfolio invested in stock one? Let me ask.
Fraction or like a whole number, like $5? Would it be $5?
Or percentage, fraction or percentage. So like how would we calculate what percent of our portfolio is invested in stock A?
Oh,
That's
okay,
what
never mind.
that's what we need for this equation.
50 divided by 80.
Yeah. Or 50 divided 50 is the amount we have invested in A divided by the total value of the portfolio, right? And the total value is 50 plus 30. And what's 50 divided by 80? Like 6.2 something?
0.625.
There we go. And so what does that mean that the next one has to be for stock 2?
30 divided by 80.
So this problem's a little different than the one you've seen before. The only difference is you have to calculate the fractions or the percentages. And it's probably a little more realistic in terms of what you might see in the world, right? Because usually you know how much money you have invested in different stocks. And so it's kind of up to you to calculate what percent of your portfolio is invested in each one. So that means the portfolio return is going to be equal to 0.625 times the return of stock 1, which we said is 0.1, plus 0.375 times the return of stock 2, and that's 20%. And let's see what that equals. So it looks like 0.1375. So that's our answer for that problem, 0.1375. Okay. Now, for variance and standard deviation, I'm just going to talk about the Excel formula that can make this problem pretty quick and simple. I'm not going to go through the math on these. If anybody wants to go through the math on these, please set up a separate session with me, okay? So here's the deal with variance. We just use the variance for the population formula. And you see right here, it's when you type in VAR for variance, it's the first one that comes up, VAR.P. So if you double click on that, it inputs the formula. And now you just have to select the range that your data is in and then put in an end parenthesis. And that gives you your variance. Okay. And then for standard deviation down in this problem, two ways to do it really. You can take the square root of this number up here, or you can go ahead and just calculate the standard deviation using the formula built into Excel. That's what I'm going to do right now. And that's the same one. We picked the one for the population, and it's stdev.p. If you double click on that and then select the range where all your data points are in, hit end parenthesis, and there you go. So standard deviation is 11.99% for those returns. And that is all I have for today.